Long call spread and long put spread are defined risk strategies. Why can they lead to account bankruptcy? Let's find out. GME has gained 80 times due to short squeeze. Many brokers has limited the option transactions, including defined risk, long spread. So why is that? Assume we open the call positions using the long 300, 400 vertical call spread. Long 300 call, short 400 call. We pay $30 per share. One spread we pay 3,000 and 30% of the account capital is allocated. So our account value is 10,000. What if GME is halted by the exchange? So when the stock is halted, both stock and the option transactions are halted. You cannot buy stocks. You cannot sell stocks. You cannot buy or sell options. And you have to manually exercise your options. No options are automatically exercised. Out-of-money call options can be exercised. This is a risky part. This is a tricky part. Usually, when we exercise, we just exercise the in-the-money options because it has very little time value. But here, some option buyers may anticipate that the stock will get up after the halting. For this example, 400 call, if you sell the 400 call and the other option buyer anticipates that after the halt, GME will get up to 500, then he may exercise his call. This makes your positions risky. Let's find out why. Also, the out-of-money put can be exercised, the same as out-of-money call. So on the expiration date, the stock is still halted, but your options are going to expire. So what will you do? You have no buying power to exercise your long call because you have to buy 100 shares at $300, but your account value is only 10,000. You do not have enough money to buy them and you cannot exercise. But it is possible that you are assigned to short the 100 shares at 400 price. Remember that even if the 400 call can be out of money, the option buyer of the 400 call can still exercise the call, and you will be assigned to short 100 shares at 400 price. So this is very risky, and when the stock is resumed for trading, like after maybe after 1 month, and you have a new position, you short 100 shares at $400, but your account value is only 10,000. Then what will the broker do? The broker will force you to buy back 100 shares at the market price. No matter what the market price is, the market price can get up to 500 or 10,000. We don't know. But in this case, because you are shorting the stock, you lose a lot of money and your total account is wiped out. So how about the long put spread strategy? It is similar. Assume that you long 400, 300 put spread, and you have the same account value, and the stock is halted by the exchange. On the expiration date, the stock is still halted. You can exercise your long put, but you don't have the buying power. So the broker will just not let you exercise even if you want to. And it is possible that you are assigned to buy the 100 shares. Why? Because you short the 300 put. Even if the 300 put is out of money, it is possible that the other option buyer wants to sell the stock at $300 because the other option buyer may think the price will go down after resuming trading. Then you have a new position, long 100 shares and 300. And after the stock is resumed for trading, you are forced to sell 100 shares at the market price, no matter how low the price is. If the price is $50 or $10, so it may happen. Now GME is overvalued. Everyone knows it is overvalued, but no one knows when it will drop. In case that after the halting, the price drops and you have to sell at a very low price, you buy it at 300 and sell it for 50. That is a huge loss and your account is totally wiped out. What are the lessons we learned? Long call spread or long put spread can cause bankruptcy if you do not have enough buying power to buy the stocks or sell short the stocks. Even if your long spread is not allocated 100% of the capital, it is still possible that after the halting, the stock gap up or gap down and your account is wiped out. There are some examples. One is LK, Luckin Coffee, was halted from April to May last year. And after it resumed trading, it gapped down from 439 to 282. That was a 30% drop. If you long put spread at that time, you need to make sure that you have enough buying power. And also the whole market can be halted. On September 11, 2001, the terrorists attacked New York and the whole stock market was halted for 1 week. So here is a chart of SPY, SP500 ETF. So the attack happened on this candlestick. The market was halted for 1 week. And after it opened, the lowest point is 9% drop. How about other stocks? This is just the average of the market. So other stock may drop down even more, like 20 or 30%, if you have a weekly long put spread expiring during the halting period. Anything could happen. Thank you for watching. Remember to click the like button and subscribe if you like it.